This video is about S&P 500 option prices, and in particular, an application of put-call parity, which really shows the power of put-call parity in the market. So I want to look at a principle here, which is that if we're trading options in the market, then we should trade the option with the best price. So generally, we don't see a single price, right? We see bid and ask prices. And if there are equivalent trades available in the market, then we should choose the one that has the better value. If we're buying, this means the lowest price. If we're selling, it means the highest price, right? So we want to, when we look at prices, if we're going to buy, find the price that has that's lowest. And if we're going to sell, find the price that's highest. Again, we're selling, we're receiving the most money. And so I'm going to show you a couple of applications here of put-call parity, which demonstrate this. So we have some market data. This is market data for the S&P 500 from the 1st of February 2021. And we're going to look at some options expiring on February 16th, 2021, so roughly 2 weeks later. And so we've got this set of option prices. I've just transcribed them here, so you've got them. Again, when I look at this expiry, there are lots and lots of options. I haven't shown you all of them. The S&P 500 on this day was trading just under 37.75. The forward price for the S&P 500 was just over 37.75, but it doesn't really matter. These are just straight option prices. And a few quick observations. A 3,000 strike call is way in the money, right? And is very expensive. A 3,000 strike put is way out of the money and pretty cheap. A 4,100 strike call is way out of the money and cheap. A 4,100 strike put is way in the money and very expensive. 37.75, you'll notice the puts and the calls are not exactly the same value. They're different by about $1, but you can see the calls and the puts are about the same value. And also, finally, last observation here, if we look at bid-ask spreads, the bid-ask spreads for the 37.75 strike calls and puts are about the same. Right? It's 50 cents for the call, it's 60 cents for the put, but it's about the same. But if we look at the 3,000 strike calls, the bid-ask spread on the calls are about $5, and the bid-ask spread on the puts is about 15 cents. Looking at the 4,100 strike, the bid-ask spread on the calls, 5 cents, and the bid-ask spread on the puts, about $6, $5 or so. So you can see that the bid-ask spreads vary pretty significantly depending on which strike you're interested in. Okay, so first we're going to think about forward contracts. Given these prices, puts and calls, we can compute bid-ask spreads for forward contracts using put-call parity. So call minus put equals the present value of a forward. That's the present value of being long a forward. So to be long a forward, we buy a call and sell a put. To be short a forward, we buy a put and sell a call. So given this, we can calculate bid-ask spreads available for forward contracts in the market. And I'm just going to go through those calculations with you. So here are our option prices, and we want to calculate the bid forward contract price. The bid, we're going to sell it with a strike of 3,000. So to sell a forward with strike 3,000, we buy a put and sell a call. We buy a put for 235, we sell a call for 775.40. The bid price, 773.05. Namely, because we sell that call, we're going to receive the 775.40. We have to pay the 235, net 773.05. Let's go long a forward. We want to go long a forward. We buy a call and sell a put. That gives us a price of 778.50. So that's our bid-ask spread for a forward contract with strike 3,000. 37.75 to sell the forward. We buy a put, sell a call. Buy a put for 64.70, sell a call for 65.10. The bid price is 40 cents. Going long a forward, buying a forward with strike 37.75. We buy a call for 65.60. We sell a put for 64.10, net 150. So we have our bid ask for the forward contracts with strike 37.75, 40 cents at 150. Finally, 4100. 4100 is a little bit strange, right? So if we sell a forward with strike 4100, that strike is way above the forward price. So it's going to have a negative value. We buy a put for 327.10, we sell a call for 40 cents, and the bid price is negative 326.70. What does negative 326.70 mean? It means that if we sell a forward contract, normally if we sell something, we would receive money. In this case, we would pay. If we sell a forward contract with strike 4100, we are going to pay $326.70. If we want to go long a forward contract with strike 4100, we buy the call, sell the put, and it also has a negative price, negative 321.35. So we want to go long a forward contract. Normally we would pay. In this case, we pay negative 321.35, otherwise known as we receive $321.35. Now, negative prices are a little strange, but they can occur, and they certainly occur with forward contracts. So if we look at our prices here, the bid-ask spread for the 37.75 strike forward contract is $1.10. We're just taking the ask minus the bid, $1.10. The bid-ask spread for the 3,000 strike forward contract is $5.45, 778.50 minus 773.05. The bid-ask spread for the 4,100 strike forward contract is $5.35. Negative 321.35 minus negative 326.70, $5.35. So if we think of value here, where are the best prices to trade? The 37.75 strike forward has the best value. Okay, so we want to trade a forward contract. We would like to trade a forward contract with the best value. But we might want to trade a forward contract with a different strike, so we have a problem. So here are our prices. We prefer to trade the 37.75 strike forward contract rather than the other two. How do we do it? Well, let's change the strike. A portfolio that consists of a zero coupon bond paying X and long a forward contract with strike K is equivalent to a forward contract with strike K minus X. A portfolio that consists of a zero coupon bond paying X and short a forward contract with strike K is equivalent to a forward contract with strike K plus X. Now, X here could be positive or negative, and I'm going to leave it to you to think about that and draw your payout diagrams, right? So the way to figure out these are equivalent is to draw the payout diagrams. One, a forward contract with strike K, and the other, one forward contract with strike K minus X, for example, and the other two contracts, a forward contract with strike K and a zero coupon bond paying X. And so if you look at these two things, you'll see that this is correct. Now, zero coupon bond, the present value of a zero coupon bond is X e to the minus RT. Right now, given the data we have, short-term interest rates are approximately 0.05%. The maturity of these options is 15 days, so the present value of a zero coupon bond is 0.999979 times X, whatever X is, which is really, really close to X, right? Because interest rates are very small. But if interest rates were bigger or the maturities were longer, right, this could be the discount factor, that 0.999979 could be significant. So we have to pay attention to it. Now we're going to assume for the moment that zero coupon bonds have no bid-ask spreads. Typically, one would expect zero coupon bonds to have low bid-ask spreads, especially relative to the options market, but it's not going to be zero. But for what we are going to assume here, we're going to assume the bid-ask spread on our zero coupon bond is zero. So let's say we want to go long a forward contract with strike 3,000. Instead of going long the forward contract, we found we have to pay $778.50 for that. So instead of doing that, we're going to do an alternative. Let's buy the 3775 strike call and sell the 3775 strike, that should be put. That's going long the forward contract with strike 3775. That we have to pay $1.50 for. And we go long a zero coupon bond paying $775. We have to pay 0.999979 times 775 or $774.98 for that. We're paying $776.48, the $774.98 plus the $1.50. So we pay to enter these two trades, or these three trades really, $776.48, rather than trading in the market at $778.50. So we saved $2.02. So instead of going long the forward contract with strike 3000, we went long the forward contract with strike 3775 and long a zero coupon bond, and we saved $2.02. Alternatively, if we wanted to go short the forward contract with strike 3000, we can go short in the market. 773.05 is the price for that, so we're going to receive that. Or sell the call and buy the put, receive 40 cents. That's the 3775 strike call. Go short a zero coupon bond, paying $775, and receive $774.98. Net, we receive the $774.98 plus the 40 cents, an additional $2.33 relative to what we could have traded in the market. Very clearly, if we want to trade a forward contract with strike 3000, we're better off trading a forward contract with strike 3775 and using a zero coupon bond to match the trade. Now, of course, one thing you might ask yourself is, why would I want to trade a forward contract with strike 3000 when I can trade a forward contract with strike 3775, which is roughly equivalent? Now is where it gets interesting. Let's look at trading options rather than forward contracts. So here are our option prices. And let's look at those 3000 strike options and the 4100 strike options. So if we look at the calls with a strike of 3000, we can see the bid-ask spread is about $5, just over. The bid-ask spread for the puts is about 15 cents. And the 4100 strike options have the opposite behavior, which is the calls have a bid-ask spread of about 15 cents, and the puts have a bid-ask spread of about $5, just over. So let's think about this. The bid-ask spread on calls, 3000 strike options, the bid-ask spread on the calls is much wider than the bid-ask spreads on the puts. If we could, we would rather trade puts with that strike than calls with that strike. But there are certain circumstances in which we'd like to trade a call, and so we are faced with this large bid-ask spread. So let me give you an alternative strategy. So we can buy a 3000 strike call using the data for $780.70. An equivalent position is to buy the 3000 strike put and go long a 3000 strike forward. You can see that with put call parity. You can see that with payout diagrams. This forward is expensive. We've just seen that. So our equivalent position is go long the 3000 strike put. That costs $220 according to our data. Go long the 3775 strike forward and long a 75 zero coupon bond. And we have to pay $776.48 for that. We just saw that. Total, we pay $220, we pay $776.48. The total is we pay $778.76 for an equivalent position to a 3000 strike call. If we bought the call in the market, it costs $780.70. We do this instead, long the 3000 strike put, long the 3775 strike forward, long a $775 zero coupon bond, and we save $1.87. Let me give you a different one. Let's go do an alternative to short a call with strike 3000. So we can sell the call for $775.40. That's the price in the market. An equivalent position is to sell the 3,000 strike put and go short the 3,000 strike forward. But of course, that 3,000 strike forward is not a great trade. So go short the put for $2.35. So we're going to receive $2.35 for that. We go short the 3,775 strike forward and short a 775 zero coupon bond. And we receive $775.38 for that. We calculated that earlier. Total $777.73. So we can sell the call for $775.40, or we can do this alternative strategy for $777.73. We're receiving an extra $2.33. So clearly that's a better trade. Now, of course, the question that you should ask yourself is, why would you want to buy a 3,000 strike call or sell a 3,000 strike call? This option's way in the money. It's not a particularly exciting option. But many times, let's think about a world where 6 months ago or a year ago, we bought a 3,000 strike call. And now we're sitting here, it's February 1st, we've made lots of money. That option, maybe it cost us $20 or $50 or something like that. And now we're sitting here several months later, just before expiry, and that option is worth $775.40 if we sell it now. But of course, if the market goes down over the next couple of weeks, we might not get $775.40. So we'd like to sell the option. Instead of selling the option in the market, we should do this alternative. Sell the put, go short the forward contract, short the zero coupon bond, and we receive $775 or $777.73 rather than $775.40. Again, $2, give or take, $2.33 on $775 isn't a huge percentage, but it's real money that if you don't do the alternative trade, it's real money that you're leaving on the table. You're giving to somebody else, and you should never do that. So this alternative trade makes a lot of sense. Now, the other thing to note with this alternative trade is the position is going to stay open for 2 more weeks, right? You've sold a call. If you are long a call and you do these, instead of selling it, you sell the put, go short the forward contract, and so on, you're going to have positions open for 2 weeks, but those positions net out. And in the end, you'll receive your extra $2.33.